You've bought your own home and it's gone up in value, right? Then I'm sure you've heard of the opportunity that comes with using that equity to buy your first investment property. But you'll need to do some planning. G'day, I'm Aaron Christie David, mortgage broker and founder of Atelier Wealth. I specialize in helping Australian families start out and scale up their investment property portfolios. Buying an investment property is a big decision, and like all new journeys, it can feel a little overwhelming. You could speak to an accountant, a financial planner, a buyer's agent, a mortgage broker, other investors, friends or family, and have several conflicting opinions about what to buy and how to buy it. So I'm going to show you how not to make 3 common mistakes that some new investors make when using their equity as a down payment on an investment property. But before we get into it, I just want to preface that this video is general in nature and not intended to give advice. I always suggest chatting to a qualified mortgage broker who can give you the best guidance for your situation. Okay, let's talk about equity. In simple terms, if the value of your home is increased and your loan balances come down, you'll have some equity in your property. So let's say, for example, that you've bought your home for $1 million and took out a loan for $800,000. Now, if your home is worth $1.3 million after getting your home revalued a few years later, your bank will lend you more money against this new valuation. You can borrow up to 80% against this new valuation, which means in this case, you can borrow $1,040,000. If you still have an $800,000 home loan that's outstanding, this means you can still access an additional $240,000 to be used as a deposit towards your first investment property. So that's equity in a nutshell. Now, let's talk about some fatal errors I see new investors make when using their available equity. The first one is not understanding the power of getting multiple valuations. I often see new investors simply go back to their original bank to organize one valuation. But you could access a fair bit of additional equity if you just shopped around for valuations. Some banks will do a computer-based valuation. Some may organize a drive-by valuation, and some banks may send out a property valuer for a physical inspection. So you could go to 5 different banks to value your home, and you could get 5 different valuations. And that's why it's vital to cast the net out as wide as possible to get multiple valuations organized. The second common mistake I see new investors make is simply relying on one bank's borrowing capacity. Look, I get it. Changing banks is hard. Direct debits, internet banking logins, banking apps on your phone, ATMs. Banks make it all convenient, so changing banks becomes, well, inconvenient, right? But that's what's important as an investor, is being able to potentially borrow more, which could help you purchase a higher quality investment property. Unfortunately, some banks will apply harder assessments to your situation by reducing the rental income you will get, bumping up your living expenses above benchmark, or not factoring your overtime or bonuses or allowances. Looking at more investor-friendly banks will ensure that you can continue building and scaling up your property portfolio, which means you potentially could have different loans with different lenders. Lastly, too many investors cross-securitize their properties. A common objection to using equity is that people don't want to risk using their own home to buy an investment property. Look, I understand the fear, but this risk can be easily addressed and minimized by not cross-collateralizing your home with your investment property. In other words, try to avoid using both properties as collateral for your new loan. Instead, take out separate loans for each new property and have the deposit and costs coming from a line of credit or your equity release loan. So there you have it. These are the 3 most common mistakes that I see new investors make when using equity for the first time. Equity is magic because it allows you to buy your first investment property without using any of your own cash. But it's important to avoid these common mistakes so that it's easy to scale up your portfolio in the future. Hopefully these tips have been handy in helping you understand how to be smart with using equity in your own home. But if you have any questions, please leave them in the comment box below. Otherwise, make sure to give us a thumbs up if you found this video helpful, and stay tuned for more property investing tips. We'll see you next time.